Dale Jorgensen, president of the American Economics Association. He spoke at a plenary session during the Aspen Summit held in Colorado earlier this week. His address was titled, "What's Next for the New Economy?" It's about 45 minutes.
It's a great pleasure for me to be with you to talk about what's next for the new American economy. You've just heard a very interesting panel dealing with the next quarter, the next year, and a little bit beyond that. I'm going to take somewhat longer view of the problem, and I'm going to focus on the next decade, which is a relatively long period of time. But it will be an opportunity, I think, for all of us to reflect on the tremendous resurgence of the U.S. economy that has taken place and to try to understand the evolving issues. I don't need to tell you that this has produced a tremendous debate among economists. There is a raging debate among deniers of the new economy who say that with some people in the investment community, it was all a bubble. On the other hand, there are enthusiasts for the new economy who feel that the economy is, as Alan Greenspan has said on many occasions, is being transformed by information technology. So this really is an excellent time. It's a good time of the year, too, because with the Congress in recess and the president on a working vacation in Texas, Washington economists are busy updating their forecasts, including those that go out as long as the next decade. Last week, we heard from the Office of Management and Budget, representing the position of the administration, and as Catherine told us, that represents pretty close to the consensus view, maybe a little on the optimistic side. This week, we're going to have an update from the Congressional Budget Office, and I'd like to look at the first slide to give you a little historical perspective on that. Projecting the future growth of the U.S. economy is a daunting task, and this is a graph which CBO published last year to illustrate just how far we have come in understanding the issues involved in making these projections. This is a chart that shows two different projections of the surplus of the federal government. So if you look at the left-hand scale, you will see surplus and deficit. And I don't need to tell you, you can see from the top of the graph that this is in billions of dollars, hundreds of billions of dollars. The lower line there represents the January 97 baseline. And of course, the graph begins in 1997. So what we're looking at there is essentially a picture of what the Congressional Budget Office was projecting in 1997, which after all is not so long ago. The upper line represents the summer 2000 baseline. In other words, it's about a year ago. And what you can see is that these two lines have diverged totally. Well, you might say, lots of policy changes, right, since 1997. Well, actually, there weren't so many. The blue area, dark blue area there, represents the effect of changes in policy. So that's the part that was due to legislation, tax cuts, expenditure increases, and so on. But, in fact, the Congressional Budget Office had to revise its projections repeatedly because of the actual experience that they were confronting. And you see in the solid line, in the upper part of the graph there, the actual development. Beginning in 1997, there was a small deficit, a lot less than they had anticipated in January. But then, instead of a deficit, the familiar unending sea of red ink that we used to expect, there was in fact a gradual increase in the federal surplus. And of course, that was the center of the debate that took place over the Bush tax cut earlier this year. Well, what that illustrates very dramatically is the force of what the Congressional Budget Office refers to there as economic and technical changes. In other words, they goofed. They missed it. They were unable, using their models, to accurately project the federal deficit or surplus. And in fact, the moral of the story is that the 1990s have been among the worst periods for economic forecasters since the 1970s. Something has changed in our economy, and this is evidence that would convince even a skeptic inside the conservative forecasting organization that serves our Congress. The question I'd like to address today is the change temporary? Was it a bubble? Or is this, in fact, something that represents a permanent change in our economy? Well, the difficulty with answering this question is obvious. Namely, this growth resurgence has, in fact, befuddled economists around the world, not just people in the United States. It doesn't conform to any of our economic models. The models are totally off track. And our understanding of the new American economy, I'm going to admit to you at the outset, is a work in progress. In fact, many parts of the picture are still incomplete. And I know that many of you are in a position to fill some of the gaps. And I'm hoping that you're going to do this now during the discussion or later when you can contact me by email or any communications medium. I prefer multiple communications, just like Tom Siebel, that you prefer. But let me begin by summarizing the 4 points that I want to cover. First of all, there is a consensus building, at least among economists, that the remarkable behavior of information technology prices is the key to the surge in growth that took place after 1995. The second point I want to make is that the rapid decline in IT prices is rooted in developments in semiconductor technology that are familiar to everybody in this room and are certainly familiar to economists by now and to technologists. No economist can talk about the American economy without talking about Moore's Law, and that itself represents a big change. The third point is that the information technology sector has become a major driving force in the aggregate economy. The investment boom since 1995 boosted growth by nearly a full percentage point, and information technology accounts for about half of this. Secondly, the acceleration in productivity growth that Catherine Shaw described in the information technology producing industries accounts for about half of the productivity surge that took place after 1995. Well, now we come to the bottom line, so I'm going to give you the message, the take-home right away, and then we'll proceed to work out the details. I'm going to argue that the boom of the late 1990s was not, let me underline, not sustainable. Sorry about that. But the ongoing development of semiconductor technology is continuing to drive IT prices downward at an unprecedented rate. And this is continuing to create new opportunities for investment and for gains in productivity, so that the growth rate of the American economy is going to be considerably enhanced from the rates that prevailed before 1995. Well, let me begin then with the first point about information technology prices. And for that purpose, I'd like to begin with Moore's Law and the next slide, if I could have it. In 1965, Gordon Moore was the director of research at a fledgling semiconductor firm in Silicon Valley named Fairchild. You're all familiar with the history of Fairchild and how it gave way later on to the whole industry, but in particular to the Intel Corporation, which Gordon Moore co-founded with Robert Noyce. In 1965, we were at the very, very beginning stages of the industry, and Gordon announced the following law. He said, I've been looking at the data on storage devices, now called memory chips, and I observed that the number of transistors on a chip doubles every 18 to 24 months. This was in 1965. What you see here is a graph that begins in the 1970s, and you will note the scale here is a logarithmic scale. The number of transistors here goes from 1,000, 10 to the third, up to 1 billion. And we're going to be getting to 1 billion very soon. And there are two lines on this graph. The lower line is the line for microprocessors. And so you can see the whole history of the computer industry here. Down in the lower left-hand corner, you can see the famous 4004, the first commercial microprocessor. This was developed, you remember, for a hand calculator that was marketed by a successful Japanese computer company, but they forgot to retain the intellectual property rights. And Intel commercialized this as a separate product in 1971. That had 2,400 transistors. Now, in the year 2000, at the end of the graph there, you can see a red dot. I hope this graph is not too small so that you can see that red dot. That is the Pentium 4. You can't find the number of transistors on the Pentium 4 on the label, and in fact, you can't even find it on the Intel website. But if you email Intel, they will come back with the answer that there are, in fact, 42 million transistors. And in fact, the number of transistors has doubled, exactly as Gordon said, every 18 to 24 months. But he said that in 1965. That's what makes it so remarkable. And the second remarkable thing about this graph is the fact that this has continued for 30 years. That is the bedrock of the new economy. The higher line there is the line for storage devices, in which the developments are even more rapid. How fast is this? Well, it's 2 orders of magnitude faster than the rate of productivity growth in the American economy. 2 orders of magnitude. It's impossible to grasp this without much exposure and lots of detail that I don't have time to go into, but is, of course, familiar to you. Well, let us proceed then to the economics of the semiconductor. And for that purpose, I'd like you to have a quick look at the next slide. And this is a slide that is once again on a semi-logarithmic graph. So this is a price index, and 1 represents the base of the price index in 1996. So everything is expressed relative to 1996. And you can see that the graph goes up to 10,000. Those of you who spend a lot of time with economic data don't think in terms of things that go up to 10,000, at least in terms of a price index, except in areas like hyperinflation. But this is, in fact, the reverse. This is a reduction in price at an unprecedented rate. Now let me explain the diagram here. I'm going to take as my benchmark the price of computers, which I have represented in blue. Anybody here from IBM can put up their hand. This recognizes you as the source of the computer industry and the leading firm for many years. But the important thing is that IBM sponsored the research beginning something like 40 years ago that had led to our understanding of IT prices. And in fact, this represents a constant performance index for computers that was originally developed by IBM and then later incorporated into our national statistical system. So it is the benchmark for all subsequent developments. What you see here are 2 lines that are much more recent, representing semiconductor prices. And again, keep in mind that a straight line on a semi-logarithmic graph represents a constant growth rate. So computer prices have been going down to 15% a year ever since they were commercialized 40 years ago. That is remarkable. But look at the behavior of semiconductor prices. What you see there in yellow is the behavior of storage devices, memory chips, which have declined 27,270 times, or 40.9% per year. And logic chips, which are represented in green there, have declined even faster, 54.1% per year. Now note the sharp acceleration in the rate of decline in 1994. Just follow that green line down to 1994, and all of a sudden it's over the cliff, right? What is going on there? Well, understanding that is the key to understanding the new American economy going forward. And so in order to look at that a little bit more carefully, I'd like to turn to the next slide, which I know that many of you are going to find fascinating, but perhaps inscrutable. Sorry about that. What this is one of these semi-logarithmic graphs again. We have a time scale there, and we have the feature size for a semiconductor device. Those of you who know what a feature size really represents are going to be horrified by this, but I'm going to call that the size of a transistor. That's not quite right, but it captures the idea. So what we see is that technological progress in this industry revolves around miniaturization. You knew that, right? More and more transistors on a chip. But the speed is determined by the product cycle. And what we can see here is the minimum feature size between 92 and 95 decreasing by a very sizable amount from 500 nanometers, billionths of a meter, to 350 in the course of 3 years. That's between 92 and 95. Then, in 94, there was an initial effort at a semiconductor roadmap to trace out the future of semiconductor technology. Many industries have roadmaps, but this is something that the semiconductor people developed about 10 years ago. And they projected the product cycle to continue at a 3-year rate, which is the top line in the graph there, out as far as we go here, which is out to about the year 2010. But of course, reality intervened. What happened between 95 and 97 is that the product cycle shifted to 2 years. Now, what does that mean exactly? Well, that means that the rate of progress in this industry suddenly jumped by 50%. It's hard to appreciate that. It's almost impossible. And in fact, the engineers, confronted by this reality, made subsequent forecasts that you can see there that said, this can't continue. We're going back to a 3-year cycle. And you see, over and over again, they kept projecting the 3-year cycle to return. But in fact, between 97 and 99, there was another 2-year cycle. And of course, it's precisely the continuation of this 2-year cycle that has driven semiconductor prices down at such a prodigious rate. Now, in the year 2000, to be precise, on December 15th, this diagram was released as the 2000 plan. And they hedged their bets. They said, well, we can project a 2-year cycle out to the year 2003, but after that, it's going to go back to a 3-year cycle. Intel announced this summer, those of you who are reading the Wall Street Journal picked this right up, right? That in fact, they didn't believe that. They said that in the year 2003, they were going to bring on a new semiconductor device that would continue the 2-year cycle, meaning it would continue for another two cycles. So the conclusion is that there's some doubt about the future of the semiconductor technology, even within the industry. And that's the kind of uncertainty that economists have to deal with. Well, so much for the roadmap. I'm going to come back to that. But what I want to focus on is the fact that semiconductor prices have a rationale. It's not as if this is just some arbitrary number that people pick out of the air. It responds to changes in the industry that reflect changes in products. And we need to understand that in order to understand the next chart, which is to look at the behavior of the prices of the key components of information technology that I'd like to discuss. Blue, once again, is computers. So that's the same chart you saw before. But now I'd like to draw your attention to what happened in 1995. Namely, computer prices had been declining at about 15% a year for 30 years. And then, all of a sudden, that rate doubled. It increased to 30% a year. So something happened in the IT sector that had to do with IT prices. Well, if you look at the story about software, which is in violet there, representing Siebel and Microsoft and Oracle, all the companies we've heard about today, you can see that the progress of software prices has not been quite as dramatic, but it has been definitely far in excess of what we see elsewhere in the economy and has continued for a very long time up to the present. In green here, we see the prices of telecom equipment. I know that's of interest to many of you. And that, of course, behaves very much like the prices of computers. So that's our story about the prices of telecom equipment. And I have now completed the first 2 parts of my 4-part program. Namely, I have described for you the remarkable behavior of IT prices, and I have related it, I hope, to the progress of semiconductor technology. However, I haven't told you that the picture is incomplete. The good news is that we have a very accurate picture of what is happening to computers, reflecting this long tradition of research in the industry. and its adoption in 1985 as part of our national accounts. But in fact, this decline in software prices is only for prepackaged software. And those of you who are experts in the industry know that what Tom Siebel provides is something called custom software, and that there's another kind of software that's very important, although it's fading, and that's own account software, the own system that you create with your own software people. And those have not been measured in the way that prepackaged software has. So that's an incomplete part of the story. That's why I keep emphasizing this as a work in progress. The story about telecom is a disgrace. Here we are, you're members of the telecom industry, many of you, and there has never been an effort in the telecom industry to understand what is going on to telecom prices. In fact, it's a big secret. Well, in fact, what we see here is that the switching part of telecom, since it's basically the same technology as a computer, behaves very much like computer prices. But what about transmission? What about terminals? Some people think that transmission is, in fact, progressing more rapidly than semiconductors. You're all familiar with DWDM, right? Dense wavelength division multiplexing. I became familiar with that relatively recently, and my first impulse was to say, buy Ciena. But those of you who follow the fate of that very important technologically progressive company know that that has been a very bad thing to do recently. In fact, Ciena has gone down just like the rest of the telecom companies, but the point is that the telecom equipment for transmission is something that has a tremendous technological dynamic, and it is not captured in the price indices that we have for information technology. So our story is incomplete. Well, we've got to get to the new economy, right? Going forward, we want to understand how all this works in the new economy. And so let's turn to the next slide and begin to build up a picture of the old economy, the old new economy that we're familiar with, and the growth resurgence, and try to understand what happened, and then see if we can project it. The color scheme here is the same as before, but now the left hand, or the vertical axis, is the percent of the national product that is associated with information technology defined as computers, communications, and software. That has steadily increased and is now slightly under 6%. Now, 6% to an economist is a small number. And therefore, the initial impulse, as Jeff said, for economists was to say that there can't be anything to this story about a new economy. It's only 6%. How can this be driving anything? The color scheme that you see here, however, illustrates some of the fine-grained features here. Green, once again, is telecom. And of course, that is the oldest part of the IT sector. That goes all the way back to the beginning of this graph in 1949. The commercialization of the computer shows a parallel development of computers in blue and software in violet, but software has emerged in the last few years as most important in dollar terms, thanks to Tom Siebel and his colleagues. So we have had tremendous growth in software, especially recently. Nonetheless, this is a small part of the economy, and the initial impulse of an economist is to say, this can't matter. So to dispel this, I'd like to look at the next slide. What we need to do is to translate this into economic growth. And for that purpose, what we need to do is to combine the dollar value, the percentage value, with the growth rate. Now, you saw that the percentage value as a percent of the GDP was rising and that the prices were plummeting, right? Therefore, it's not surprising to you that the growth has been very dramatic. Because if we weight the growth rates by those relatively small dollar numbers, we still get pretty sizable growth rates. And of course, from 95 to 99, which is the last bar in this graph, we get a tremendous jump. That has something to do with the progress of semiconductor technology I told you about, right? The color scheme is the same. Blue is computers, and we see that that's more than doubled. Green is telecom. That's underestimated because we have inadequate prices. And violet is software. And even with the inadequate prices we have, you still get pretty dramatic gains. So that by the end of the period, about 1% out of our 4% economic growth from 95 to 99 is due to this little tiny sector, the IT sector, and is being driven by the developments in information technology that I described. Well, let's try to put this in context. Give me the next slide, and I'll show you how important IT is in the overall capital picture. Capital is a very important source of economic growth, and in fact, by the end of this period, which again starts in 1948, it has become the most important. IT accounts for about half of all the capital accumulation that's going on in this country. That is, in itself, quite remarkable. But you can see that IT has been around for a while, and in fact, beginning in 1973 and through the early part of the 1990s, IT was, in fact, already a major driver in the accumulation of capital in our economy. And now what I'd like to do is to put this again in context by talking about productivity. Catherine Shaw told you that productivity is really a key, and what I'd like to do is look at the next slide and show you some figures on productivity. But now I want to add to your economic knowledge. One thing that is very confusing for non-economists and for many economists as well is that productivity is used in two different senses by economists. One is the idea of labor productivity, output per hour, which is what Catherine used in her discussion. And the other is output per unit of all input, including capital. And that's what I'm using here. So what I've done is to display the growth of productivity in terms of percent per year from 0 to 1%, and I put the IT part in the dark yellow. That's the part that is due to productivity growth in the IT producing sectors. Now, what you notice from this graph is that productivity used to be a lot higher. Productivity growth used to be a lot higher, and information technology used to be a lot smaller. But beginning in 1973, this is a long time ago, IT has in fact accounted for most of growth in total factor productivity, output per unit of all inputs. So for 30 years, we have had a momentous contribution from IT to the overall productivity of the economy. In fact, from 1973 to 1995, IT accounted for most of productivity growth. During the early 90s, that's because there wasn't any elsewhere in the economy. Since 95, there has been a huge jump in the IT contribution, and of course that was signaled by the rapid decline in IT prices, because after all, IT producers are using the same factors of production as everybody else. If they can drive their prices down at these prodigious rates, they must be undergoing tremendous productivity growth. You see that between the early 90s and the end of the 90s, there was an increase in the growth rate of almost 2%. And that was due to a modest increase in labor, but mostly due to a tremendous increase in capital, of which about half was due to IT, and then, of course, the tremendous jump in productivity, defined as total factor productivity, and part of that was due to IT, about 0.25%, and the other 0.25% was due to non-IT. Well, needless to say, I've now finished the third part of my discussion, and I want to turn to the future. But let me just summarize where we are. First, the most remarkable behavior in the U.S. economy is the behavior of IT prices. And I have argued that this provides the key to the surge in economic growth that took place after 1995. Computer prices began to decline more than twice as fast in 1995 and generated an investment boom and a wave of substitution toward IT. And of course, it wasn't just computers. Secondly, this is understandable at one level, namely the decline in prices of IT can be traced directly back to developments in semiconductors that are very well understood by technologists and are in fact have been projected in successive semiconductor roadmaps like the ones that I showed you. And finally, what we have had during the period since 1995 is due to the changeover from a 3-year cycle in semiconductors to a 2-year cycle and the ensuing rapid decline in prices. Now, this is not a very romantic story. This is kind of the engineer's view of the world, which I have adopted for this purpose. If you were to hear this story from David Hale, which you recently did, the whole story is how this attracted all these dollars and all of these entrepreneurs and all these financiers and all these private investors and venture capitalists, and all they joined in to take advantage of these opportunities, and we're all grateful to them for that effort. But what we need to understand is that this rapid price decline is contingent. It will continue as long as the 2-year cycle continues, which is what Intel says will go on for quite a while. But more conservative engineering thinking goes in the opposite direction. It says that the 3-year cycle will shortly reestablish itself. Well, we're now ready for the question. You don't get to vote yet, but we're ready for the question. The question is, what is next for the new economy? How much of this growth was permanent and how much was transitory? So I'm going to leave this diagram up for a while, and I'm going to go through this sort of step by step, and please be patient. I realize this is the part that seems a little schoolmasterish, and I apologize because we just want to spell out the facts here. Well, the first thing we need to look at a little more carefully is that red part, because labor input, in fact, grew at a pretty healthy rate, a little over 2%. And that produced the contribution that you see here to economic growth of a little over 1%. That was not sustainable because it involved growth of hours worked at a rate that was far in excess of the growth of the labor force. The reason for that was, 1, that we had a big decline in the unemployment rate. Remember that? 2, we had a sizable increase in the participation rate, the number of people out of the population who were participating, and a little part of that was due to the welfare reform, which you've heard about, but not in this context. If we think about what a sustainable rate is, the answer is about 1.1% as opposed to 2.2, but we can augment that a little bit, maybe 0.3%, to allow for an increase in the productivity of the average worker due to better education and more experience. So going forward, I'm going to say 1.4% rather than 2.2. Now we come to the bad news. That knocks 0.8% off the growth rate right there. Now you understand what Alan Greenspan was worried about. In 1998 and 1999, the Fed was rapidly ratcheting up interest rates after having held back for years. Why? Because they knew that this growth was not sustainable. They were looking at the same numbers we're looking at now. Those numbers didn't require any sophisticated techniques to understand. They were simply hours worked, good or bad, in quality. But nonetheless, they knew that it was not sustainable, and they moved to stop the boom. And they were successful, very successful. As we've heard, we heard a whole panel devoted to just how successful they were. The second part of my story talks about total factor productivity, again in yellow. And there, everything is very heavily dependent on semiconductors and the associated innovations. And so I'm going to say that out to the year 2003, just to be conservative with a small c, that productivity growth is going to continue. And after that, I'm going to hedge my bet by saying that I think that reversion to a 3-year cycle would pull us back to a IT contribution that is more like what we had in the early 90s. So that knocks about 0.25% off the growth rate. So after that, going forward, my projection would be for somewhat less robust growth. But we haven't finished yet, because we haven't finished the most important part of the story, which is capital. What should we expect about capital? Well, in the long run, capital has to grow at the same rate as output. And you can see that in any economic graph. I didn't have time to present that here, but it's something that is a very well-known empirical regularity. However, during the period from 95 to 99, there was a special feature, which you can pretty well capture in this graph, which was the fact that there was a tremendous substitution in favor of information technology because of this precipitous price decline. And as long as the 2-year cycle continues, that's going to continue. And so that leads me to believe that, in fact, the contribution of capital is going to be maintained, at least out to around 2003. But after that, I'm going to hedge my bets and end up with a somewhat more conservative forecast. So I put all this together, and I project for the next decade that there will be a growth rate of about 4.1% if there is a 2-year cycle in semiconductors, and if that continues, as Intel says it will, and a 2.8% growth rate if there's a 3-year product cycle. 4.1% and 2.8%, you're going to call that a forecast? I didn't tell you this was easy. This is hard. This is very difficult. It's something which involves tremendous uncertainty, and you, of all people, have to face that uncertainty. But if you want a benchmark going forward, my projection would be about 3.2% for the next decade, which turns out to be precisely what OMB's projection was for the year 2002. So that call is hitting it on in the button. If you want to translate this into productivity terms, then it turns out that what you would come out of this would be that Catherine Shaw is right. We are going to have increased productivity growth in terms of output per hour worked at the rates that prevailed from 95 to 99. And that is as a result of the new economy. Well, this is an interesting exercise, and it's certainly something that you'll want to revisit as the forecasts come out. You'll get CBO's version of this later on this week. You can see it on their website. But I'd like to underline, I should say, in closing, the idea that this understanding of the new economy is something we're all working on. We, in fact, have a work in progress here. We lack essential information about IT prices. We don't understand semiconductor technology. We don't have any models that project the product cycle. And we simply do not have a reliable means of doing economic forecasts. Well, you might say, this must be a terrible time to be an economist, right? Facing all this uncertainty? No, quite the contrary. Our business is what we call counter-cyclical. The demand for our services goes up when the economy goes down, and vice versa. You weren't listening to a lot of economists during the great boom. You were listening to technologists telling you about broadband and all that kind of stuff, right? Well, here we are in a bit of a downturn. We now have, in fact, the opportunity for a new research agenda, and here is just a quick list of my favorite topics. One, what happened to the equity valuations? We heard about that this morning, but we certainly don't understand it. We didn't have time to talk about the very important changes in our wage structure that are taking place that economists don't understand, but this is something that many people are going to be working on. Thirdly, we don't have a good picture of the IT industry, and in particular the semiconductor industry, and therefore we really pretty much have to rely on the engineers. So my conclusion is that the new economy has given economists an unprecedented opportunity. In fact, I think it's going to refresh our thinking, and I hope that it's going to revitalize our discipline. Thank you. Want to take some questions? Yeah, I'll take some questions. Microphones are available as always. Please.
Chris Kane with IBM. You didn't comment on the impact the popularization of the internet had on these statistics in your analysis. You talked about semiconductor technology and you talked about many other things, but could you comment upon the linkage between the popularization of the internet and the connectedness with productivity growth?
Right. Well, it turns out that the internet is represented in this story by the hardware and the software that is used to support the internet. So that what I've tried to do here is to capture not the output of all the things that the internet has brought us, but rather the inputs that make that possible. The hardware, the software, the telecom equipment. Now, I don't mean to suggest that we have a complete picture of that, because some of the most important parts of the internet technology, for example, routers for data transmission, are things that we have measured price changes for only within the last few months. So again, this is a part of the work in progress. But the internet is in there, and part of this surge in productivity that you see after 1995 is certainly due to the commercialization of the internet. But we don't have a box in our GDP that is labeled the internet. Nonetheless, we can see the things that are driving the internet, and they are precisely the things that I mentioned, namely semiconductor technology. To put it another way, what I've tried to focus on here is the pace of change and how the change in speed associated with this very rapid development of semiconductors is driving what took place after 1995. And like the boom and crash in the stock market. The internet is on the surface there, but is not part of the root of the story as I see it.
Yeah. Is it me? Am I up? This is Eric from Forbes magazine again. Are we in any danger of deflation?
No, we're not in any danger of deflation. As you know, the Japanese price index is going down at somewhere between 0.5% and 1% a year, depending on how you measure it. And that's a very serious problem, which the Bank of Japan is trying to deal with. We have a robust rate of inflation. It's around 3% a year. Even if you take into account all the omissions from the way in which we've measured our price declines, it couldn't be more than, say, 2% a year. So our inflationary situation is pretty healthy. And I think that speaks to the quality of the managers of our monetary policy. They have targeted on inflation, at least that's what my colleague Gregory Mankiw says, and I think very effectively. Sorry about this little downturn, folks. That's just one of these things when you target on inflation. As Catherine pointed out, we didn't target on the business cycle, we didn't target on the stock market, we were trying to control inflation, and that's what the Fed succeeded in doing. So the answer is no, we're not in danger of deflation.
Dan Gear at Stake. Sometimes the new economy is referred to as the information economy. Could you comment on how one values information in the models that you prepare?
Yeah. Well, the information, of course, is part of every product. That's the story about distribution channels that we heard in the keynote address this morning. And as part of the value of each of the things that we buy at the retail level, whether it's an investment good that we purchase as part of a business-to-business internet consortium, or it's a retail item that we buy at the corner drugstore, all of that is built in there. So the way in which we get the information content is through the other products. In other words, it's packaged with the other products. Now, the fact that our prices have not been rising very dramatically means that we have had ongoing productivity, including in the use of information. And a large part of that is driven by the developments in hardware and software, which I've tried to describe here. But again, just like the internet, there is no box in the GDP that says information. And some people have argued that we should have such a box. And I think one could make a very good case. Then one could try to make a bit of a separation, as I did in assessing productivity here, and try to find out what part is due to IT, and therefore to information, and what part is due to everything else in the economy. My story, as you just saw, is that IT is a big part of the story, and that improvements in IT is really the core of what has happened over the last 3 decades in productivity, and is a very important part of the acceleration that took place after '95. The last one right here. I'm sorry, please.
Yes, sir. Mike Maybach with Siebel Systems. It might be a better question, but the slope you showed with computing, semiconductors, et cetera, is it consequential that at least a lot of us have the impression probably that ISP costs are pretty flat, that telecom rates are pretty flat, that bandwidth is not ramping up? Are these consequential of this story? In other words, if we had some price declines in those metrics, would that drive some of this productivity as well?
It would, and that is something, as you just pointed out, that we haven't succeeded in measuring very well. There are efforts at the FCC and elsewhere to try to get something going in this area, but it's certainly something that we haven't measured and therefore haven't included in this story. But it's not so big a part of the story that I would be worried about deflation. I think it's more something that would be in the second digit, so to speak. But it's an important issue, and something that would be a much more direct way of dealing with this, because we need to understand how information technology works in the most important sector of all, namely the telecommunication sector that is delivering the services that you described. And if you look at the price data for those services, it certainly doesn't give you the same kind of impression that you get from the price data that I described. So that's a very important gap, which I hope we'll be able to fill. You've been a great audience. I really appreciate your attention. Great job. Thanks an awful lot.
I am going to propose that we yield to the forces of nature for about 3 minutes and take a very quick break while we're setting our next panel. Join me in thanking Dr. Dale Jorgensen for a great presentation.